Welcome to the Deep Dive. Today we're jumping into something you've probably seen, maybe even worried about. It's this graphic doing the rounds online. Some people are calling it the scariest chart in the world.
Oh yeah, I know the one. It's definitely eye-catching, stark even, because it taps right into that big fear about technology, doesn't it?
Exactly. Shows these two lines going in completely opposite directions. And the starting point they picked, November 2022, right when ChatGPT burst onto the scene.
Right, so you've got the S&P 500, representing capital investors
Yeah.
shooting up, what is it, about 68%?
Yeah, roughly 68% since then. But then the other line, U.S. job openings representing, well, us, labor. It's plummeted,
Yeah.
down over 30%.
31%, I think. And the story everyone tells is, well, pretty straightforward and honestly pretty frightening. AI is making investors rich while it's killing jobs. The market's up because labor is down.
It fits the narrative, definitely. But as we started digging into the sources you flagged, something interesting popped up. The numbers themselves, they're actually solid. The S&P did soar. Job openings did fall that much.
Uh-huh. The raw data points are correct, but the why. That's where the story goes off the rails. The link they're drawing between the two. It's almost certainly, well, spurious. A coincidence.
Classic case of correlation not equaling causation.
Or textbook. You've got two trends happening for different reasons, driven by a third factor nobody's mentioning in those viral posts. So the chart uses real data, but it spins a false economic tale.
Okay, so that's our mission for this deep dive then. Let's confirm the data, sure, but then let's really take apart that flawed story, find out what's actually driving these trends.
Okay.
Let's unpack this. Right. First things first, let's just lock down those numbers. The S&P 500, it started around, what, 4,080 in November 22?
Yep, just about 4,080. And recently it's been flirting with 6,900 or so. That 68% jump is real. Verified.
Okay, capital side checked. Now, labor. We're talking JOLTS data here, right? The job openings and labor turnover survey.
That's the one. It's the Fed's preferred measure for labor demand. And yes, it dropped from about 10.5 million openings back then
Late 2022.
to around 7.2 million more recently. So that 31% decline. Also confirmed, the numbers aren't made up.
So the data is real.
Hmm.
But the conclusion, AI is the culprit. That's where the problem lies. You mentioned a fallacy.
The base effect fallacy. It's all about the starting point they chose. November 2022. Why then? Only because of ChatGPT's launch. Economically, for the job market trend, that date is, well, it's arbitrary.
Okay, help me zoom out. If November 22 wasn't the start, when did job openings actually begin to fall?
Much earlier. 8 months earlier, in fact. The peak, the all-time record high for job openings after the pandemic craziness was March 2022.
March, okay.
You had 12 million openings then. 12 million. So by the time November rolled around, the cooling trend was already well established, nearly 3/4 of a year old. Nothing to do with ChatGPT becoming a household name overnight.
That context changes everything. And the S&P, that 68% climb sounds amazing, but where was the index at that starting point in late 2022?
It was basically scraping the bottom. It was in a cyclical bear market, hammered all through 2022 by inflation fears, by rising interest rates.
So naturally, if you start measuring right at the low point, any recovery is going to look explosive. The timing for both lines was just perfectly chosen, maybe unintentionally, maybe not, to create this illusion of AI causing some simultaneous boom and bust.
Right. So if the job market cool down started 8 months before the big AI splash, we need a different explanation. We need to look somewhere else. Not Silicon Valley, maybe.
Exactly. Look towards Washington, D.C., specifically the Federal Reserve.
Yeah?
Because that drop in job openings, it wasn't some unforeseen disaster. It was, believe it or not, the intended result of the Fed's actions.
Wait, hang on. You're telling me the Fed wanted fewer job openings? That sounds completely backward to most people, surely. Fewer jobs seems like a bad thing.
Well, yes and no. It was absolutely the plan. Remember 2022? Rampant inflation. The Fed was worried about a wage price spiral. Workers demand higher pay, companies raise prices, workers demand more pay, and round it goes.
Okay, I remember the inflation panic. So the Fed's main tool to break that cycle is raising interest rates, make borrowing more expensive. That slows down the whole economy, cools demand, and importantly, makes companies think twice about hiring so aggressively. It reduces that heat in the labor market.
And the falling JOLTS number is just the medicine working. It's things getting back to normal, not collapsing.
Precisely. That 12 million peak was the anomaly, fueled by pandemic stimulus and weird distortions. Economists generally see 7.2 million openings not as a catastrophe, but as a sign of a cooling, more balanced market. a normalization.
And if AI was causing mass layoffs, we'd see it elsewhere, like in unemployment numbers?
You'd expect to, yes, but we don't. Layoff rates are still historically pretty low. And another key thing, the quits rate, how many people voluntarily leave their jobs. Usually because they're confident they can find something better, that's low too.
Interesting. So people are staying put.
Yeah, workers and employers are kind of in a holding pattern, cautious, which is pretty much exactly the tenuous balance the Fed was aiming for with those rate hikes. For now, AI is more of a sideshow in the big picture labor story.
Okay, that really reframes the labor side. The Fed's the main character there. So what about the market side, that huge S&P surge? If it's not because jobs are disappearing, what is driving it? Here's where it gets really interesting.
Right. This is the chart's second big mistake. Treating the S&P 500 index as if it is the whole economy. That 68% gain, it's incredibly misleading. This hasn't been some broad economic recovery lifting all boats.
No.
Not even close. It's actually been one of the narrowest stock market rallies we've seen in decades.
And I bet I know why. 7 specific companies, right? The Magnificent Seven.
You got it. MAG7. The numbers here are pretty wild. Just those few huge tech stocks, the ones everyone associates with AI, they account for something like 75% of the S&P 500's total gains since ChatGPT launched.
Wow. Hold on. 3/4. 3/4 of that huge green line on the chart is just 7 companies.
Yep. So if you just owned an average stock or maybe an index fund that wasn't so dominated by them, your experience was very different, much less spectacular.
And it's gotten even more extreme lately.
It has. Look at 2024 performance. The Mag 7 up something like 48% annualized. The other 493 stocks in the index, the S&P 493, they were up only about 16%.
16 versus 48, that's a huge gap.
It's massive. This isn't widespread economic health shining through. It's a highly focused bet driven by sentiment, maybe even hype, around the future potential of AI for these specific companies.
Is there a way to, prove this concentration isn't just a quirk, systemically?
Yeah, the classic way analysts look at this is comparing the regular S&P 500 index, the cap-weighted one, ticker SPY, with the equal-weighted version, ticker RSP.
Okay, explain that difference, Cole.
Sure. The standard SPY is cap-weighted, meaning huge companies like NVIDIA or Apple have a massive influence because their market capitalization is so big. Their ups and downs move the whole index a lot. But the equal-weighted index, RSP, treats every company the same.
Oh.
Apple has the same weight as the smallest company in the S&P 500. It gives you a much better picture of how the average stock is doing.
And the gap between them
Has been enormous. In 2023, the regular S&P 500 outperformed the equal-weight version by a record-breaking 12.5%.
12.5%.
Yeah. That kind of gap is a huge red flag. It tells you the rally isn't broad-based. It's not driven by fundamental strength across the economy. It's a concentrated, almost speculative bet that these few tech giants are going to capture almost all the future value from AI. It's pricing in future hope, not necessarily current reality across the board.
Okay. So Fed cooling labor over here, AI hype bubble inflating a few stocks over there. We still need the connection. How do the Fed's actions on jobs actually fuel the S&P surge? Because they seem like opposite forces.
But they're linked through market psychology. Think back to 2022 again, Fed hikes rates. What happens? Both JOLTS and the S&P 500 get crushed, right?
Yeah, both went down.
But then, moving into 2023, 2024, the Fed keeps rates high, and that JOLTS line keeps falling. The labor market keeps cooling. And the stock market looks at that falling JOLTS line and thinks,
Inflation must be getting under control.
bingo. They see the cooling labor market as proof the Fed's plan is working, inflation is easing. And if inflation is easing, what does the market start dreaming about?
The Fed cutting rates. A pivot.
Exactly. Lower interest rates, easier money. And there is absolutely nothing the stock market loves more, especially high-growth tech stocks, than the prospect of cheap money coming back. That falling JOLTS line became the ultimate bullish signal. It was the all clear they were waiting for.
So hang on. The very thing in the chart that's supposed to represent labor's demise,
Yeah.
the falling job openings,
Yeah.
it was actually seen by the market as good news, fueling the S&P rally.
Perverse, isn't it?
But yes.
The market saw the Fed achieving its goal on inflation, evidenced by cooling labor demand, and started celebrating the anticipated end of tight money. The real link here is monetary policy expectations, not AI suddenly vaporizing jobs.
Okay, the macro picture is clear. Fed action, market reaction. But let's zoom back in on AI itself. If it's not causing mass job destruction yet, what is its actual measurable impact on work right now? That Yale study looked into this.
Yes, the Yale Budget Lab did. They specifically searched for signs of broad labor market disruption from AI since 2022. Their finding was pretty clear. No discernible macro-level disruption. They basically said current generative AI isn't really eroding the overall demand for thinking jobs across the economy. Not yet, anyway.
So the story isn't displacement, it's augmentation, making workers better.
That seems to be the dominant effect so far. There was that St. Louis Fed study looking at workers actually using these tools. They found those workers saved, on average, about 2.2 hours per week.
2.2 hours, that's not trivial. That's over 5% of a standard work week.
Exactly. And scaled up, that could mean like a 1.1% boost to overall economic productivity. And get this, during the specific hours those workers were using the AI tools, their productivity jumped by 33%.
33%. Okay, now I see why the market gets excited about the long-term potential, even if it's getting ahead of itself.
Right. That's the efficiency game the market is betting on these companies capturing down the line.
But, okay, listener question time, because we do hear about tech layoffs, right? Big names cutting jobs. How does that fit if AI is mainly augmenting right now? It seems like a paradox.
It does seem paradoxical, but you need to look closer. It's what some are calling the great reshuffling within tech. If you look at the official BLS data for the whole information sector, overall job openings have actually got up recently, from about 135,000 to over 170,000.
Wait, openings are up despite the layoff headlines. How?
Because they're changing what kind of jobs they need. Dig into specific job posting data, and you see demand falling sharply for more routine tech roles. Think certain kinds of software testing, basic code maintenance, maybe some front-end stuff where AI can now do a big chunk of the work.
Okay, so those jobs might be declining.
But at the same time, there's a hiring boom for different roles. Roles focused on building, managing, and leveraging the AI itself. Machine learning engineers, AI product managers, prompt engineers. Those jobs are in high demand.
Ah, so it's not just net destruction, it's a shift.
Yeah.
Displacing some routine tasks, creating new, maybe higher value, creative tasks.
Exactly. Transformation, not just elimination, at least in this sector for now. And this fits with academic models, too, like the one from Georgia State University. They make a useful distinction.
Between different types of AI.
Right. They say generative AI, the language, creativity stuff like ChatGPT tends towards augmentation. It makes existing workers more valuable, so it often leads to more hiring overall, just different roles.
Right.
Whereas robotics and perception AI, the stuff doing physical tasks, that's more likely to lead to direct displacement of manual labor. And the current AI boom, the one driving the Mag 7, is overwhelmingly in that first category, the augmentation category.
That makes a lot more sense. It puts the current situation in perspective. Okay, let's look ahead. The scary chart makes it look like these lines will just diverge forever, but forecasts suggest stabilization.
Yeah, the projections don't show jolt tests going to zero or anything drastic. Econometric models are forecasting job openings will likely level out, maybe around 6.6 or 6.7 million in 2026 and 2027.
So settling into that cooled, balanced state you mentioned, the new normal engineered by the Fed.
Pretty much. The line isn't crashing, it's stabilizing.
And the stock market. More modest gains expected.
That seems to be the consensus. Analysts see the S&P 500 continuing to climb, but maybe not at that breakneck pace. Targets are more in the, say, 6,900 to 7,200 range by mid-2026. Still assuming the AI theme plays out long-term, and crucially, that the Fed does eventually ease policy.
Okay, so what does this all mean? Let's try and synthesize this.
Well, it means the whole viral narrative connecting the S&P surge directly to AI killing jobs is built on shaky ground, really just a coincidence amplified by that November 2022 start date.
The real divergence isn't simply capital versus labor or AI versus humans. It's actually twofold, right?
I think so. First, there's this huge gap between the market's sentiment about AI pricing in years, maybe a decade, of benefits today and the actual economic reality, where we're just seeing the early positive but still nascent effects of augmentation in the labor market.
Sentiment way out ahead of reality. And the second divergence
Is the one inside the S&P 500 itself. The massive gap between the magnificent 7 halves and the other 493 companies, the S&P 493, which arguably represent the broader real economy much better. That internal split tells a much more important story than the chart everyone's sharing.
So the chart isn't scary because AI is currently destroying the job market on a mass scale. That's not supported by the broader data right now.
No. If it's scary to an economist, it's scary because it looks like a classic financial bubble. Highly concentrated, driven by intense sentiment and future hope around a new technology, rather than broad current economic strength. That pattern is historically, well, volatile.
That's the real takeaway. The fear might be misplaced for now, focused on the wrong thing. Which leaves us with a final thought, a provocative question for you, the listener, to chew on this week. It builds on those productivity gains.
That 2.2 hours saved per week.
Exactly. If generative AI makes workers significantly more productive, saving them time, and companies capture that efficiency as higher profits, what responsibility, if any, do those companies have towards those workers? Should employees share in the value created by the AI that's augmenting their abilities and expanding their output capacity? It's a fundamental question about how we value work in the age of AI. Something to think about.